Welcome to the Jill on Money Show. It's Friday, November 29th. I hope you had a great Thanksgiving. Of course, it's also Black Friday, and it's just so silly. I'm not a fan of the Black Friday mania, but maybe it's losing some of its luster. Anyway, if you want to read about the impact of the holiday spending season on the economy, when you go to JillOnMoney.com, go to the blog section. I've written about it. While you're there, don't forget, if you've got a financial question, you've got a big year-end question, you want to think about tax loss harvesting, give us a holler. Upper right-hand corner, Contact Us button right on the front door of the JillOnMoney.com website. So I encourage you to check that out. Let's do some emails. This is from Cindy, who writes, a coworker just shared some disturbing news about Social Security, and I just want to know if you've heard of this. A few years ago, her father at age 70 filed to collect Social Security, expecting the full amount. He received both a military pension and a pension from the Department of Defense. He paid into Social Security the whole time. Social Security informed him that because he has pensions, he would not get his full Social Security amount, and his benefits were cut by about 30 to 40% of what the estimate had said. This same coworker's husband just turned 60, and he received a letter from Social Security that advised if he receives a pension, which he does, he would not receive his full Social Security estimate when he files at his full retirement age or later. What in the world is this all about? I work for the federal government. I too will be receiving a pension. I pay into Social Security. I've never heard of a reduction in benefits simply because I'll have a pension. Thank you so much for any light you can shed on this. Okay, Cindy, this is called the windfall elimination provision of Social Security, and it can affect how Social Security calculates your retirement or disability benefit. This can often impact those folks who have had a pension benefit coming to them, and it's a complicated formula, but the windfall elimination provision has some carve-outs. And I just looked up on the website. It says the windfall elimination provision, or the WEP, does not apply if you are a federal worker first hired after December 31st of 1983. So I want to make sure that you are checking in with this. It also says an exception is if you have 30 or more years of substantial earnings under Social Security, and it does not apply to survivors' benefits. So I think it's important to get back in touch with Social Security to really understand your specific case or your friend's specific case, and that way you can prepare for it. Sometimes the information isn't conveyed correctly. You want to just double check. This is from Jake, which is a pretty broad-based question, but I'm going to tackle it. Which financial planning company is the most honest, reliable, and most upstanding regarding the client's best interests? Okay, listen, I don't know. This is something you can't just say the most reliable and this, that, the other thing. What we can say is the financial planning firms that are fiduciaries, that gives you at least a leg up. And I think that that's the place to start. That's the types of organizations that put their clients first, put their clients' needs before their own or the individual advisors. That's number one. The next question, he says, which portfolios give you the best growth with the least risk? Come on, man. Who knows? You just have to pick a portfolio that is in line with your risk tolerance. And the next question Jake has is, are there ways to avoid or lessen the amount of taxes paid on your investments? Yes. Absolutely, there is. If you're working with an advisor, that is something that you should be doing every single year, is talking about your tax liability. Your question is it better to invest in precious metals indirectly or with a financial advisor or with a company that deals in gold or silver? I don't know. I feel like precious metals, just buy an exchange traded fund or a metals fund. It's a lot easier to do that. Oh my God, he's got 1,000 questions. The next question is about irrevocable trusts. How are they taxed? An irrevocable trust pays its own taxes. Irrevocable means not changeable. And that trust is outside of estate taxation. So it would fall, whatever asset is in that irrevocable trust is outside of estate taxes, but not income taxes. And last, can your pension money be transferred to a Roth IRA? Well, first of all, your pension money is taxable. And if you then have other income that is earned income, you could use that to contribute to a Roth IRA. But pension income is not considered earned income, so you can't put it straight into a Roth. Whew, Jake, that's a lot of questions you ask. Randy writes, my mother has 4 accounts with Edward Jones, a brokerage, a Roth IRA, a traditional IRA, and another traditional IRA that was used to buy an annuity. She would like to transfer all of these accounts to Vanguard. but she is nervous about the transfer of the annuity IRA. The annuity has been paying monthly for several years now. It's called Bright House Variable Annuity Class A. The reason she would like to transfer is to avoid the commissions and high fees that are charged on the other 3 accounts. Okay, what my understanding would be is that those 3 accounts can be transferred. But if she is receiving the money from that annuity, she's already pulling money out, it is annuitized, chances are she's not going to be able to move it. If that's the case, so be it. Now, you can talk to Vanguard and ask if they will hold that variable annuity, but they make that decision. And listen, if she has to keep that annuity there, fine. That's fine. Everything else is a straightforward tape-to-tape transfer from one custodian to another. So I just want to be clear about that. Okay, Kara says, I have a very generous pension and I will collect $12,000 to $18,000 in pension payments monthly, depending on how long I choose to work, retirement at 55 versus 63. I contribute a mandatory 5% to this bucket. My current 457 and 403B contributions were all pre-tax in order to reduce my adjusted gross income enough to stay in the 24% tax bracket. I make $224,000 now and I'm single. I'm still saving the max in a 403B as pre-tax, but started putting $6,000 a month into a 457 Roth since I don't have any other Roth. Question, do I need any Roth savings? Should I do more? I have about $60,000 in cash and I just started a brokerage account with $10,000 of that. I've only made enough money to really focus on savings in the last 5 years. But going forward and planning for retirement as early as 2030 at age 55, I'd like to make sure I'm balancing my current tax implications and future tax implications as well as cash savings. I itemize deductions currently and I give away about $15,000 a year, so that also impacts my AGI. Long story short, I know I have enough in retirement because of my pension, which also includes healthcare, and I will be eligible for Social Security. So how should I rebalance my savings for the short and long term? You know what? I get where you're going here. I don't think this is such a terrible situation. I know that Mark would probably want you to be all Roth, but it sounds like you've got about $250,000 in pre-tax savings. And if that's the case, then we can get that money out pretty easily when you do retire. And one way to get it out, considering that you are charitable, is that you can pull the money out when you retire. You know, you're 55, you'll have enough money to live on from the pension payments, but then you turn 59 and a half, you can start pulling money out. You can actually pull it out as early as 55 if you want. You can pull that money out, make sure that you pay the tax that's due. If that money starts to really pile up, when you're 70 and a half, you'll be able to use your pre-tax money to make contributions through a qualified charitable distribution. So maybe that's the way to go here. I mean, I know Mark wants you to do all Roth, but I don't know. I don't think you really need to worry about that. I feel like we've got many ways to get that pre-tax money out. This last question is from Sean, who writes, I'm a financial planner in Canada, and much of the advice you have about taxes and stuff is somewhat relevant. Honestly, I love the advice you give to people who call, but it always seems fairly straightforward to me. What you do way better than I have ever done is the way you frame it with people. I steal so many sound bites from you that I feel guilty about it. I try to at least credit your books to the clients who were interested. I just read your book about change, and I closed a client that I didn't close last year by introducing this gap year idea and recommending your book. It's such a great strategy for clients who want to retire but can't and really just need to change. Oh, Sean, that's so nice, and it really means a lot to me. Thank you so much. I am delighted that you can steal from me anytime. Anytime. Any financial advisor wants to steal from me, go for it. I'm happy to have you do it as long as it helps you and, more importantly, your clients. All right, that is it. That is the program. Thanks so much for listening. You can subscribe to us on the Odyssey app or wherever you find your favorite podcast. And please leave us a rating and review wherever you listen. Our music is composed by Joel Goodman. Mark Talercio is our executive producer and king of all things web, and we are distributed by the fine folks at Odyssey. Please lift someone up, change your work, change your wealth, change your life. Thank you for listening, and we'll talk to you tomorrow.